Smart moves before 2022 is over. Okay, so I put 5 smart moves, but at the end there's a whole checklist, okay? So it's a lot, but it's really 5 main ones. Before we jump in, I have to let you know that everything I talk about today is not individual financial advice, not tax advice, no legal advice, anything like that. It's not a solicitation to offer, buy, or sell any sort of anything, okay? So let's get started. Okay, so first thing, workplace retirement plans. You have a couple weeks left to max these out. So 401k, 403b, TSP, and contributions. If you have not maxed out, you have until December 31st to do so. IRAs, however, so this is IRAs, traditional, and Roth IRAs can be funded until tax day, basically. So 4/15/2022 for 2021. So if you want to figure out your tax situation first, once a year closes out and you haven't maxed out your IRAs, you have time for that. But your workplace plans do have to be maxed out or do have to be contributed to before December 31st. If you have turned 50 this year and you're now 50 or older, you are now able to put in your catch-up contributions, which brings your total allowable 401k contributions up to $26,000. For 2022, retirement account maximums have been increased. And so this is something you definitely want to take advantage of. And you might want to make sure that you are getting your 2022 contributions adjusted properly for January so that you can max this out if that's what your goal is. IRAs did not go up, by the way. So 401ks and other workplace plans have gone from the basic contribution of $19,500 up by $1,000 to $20,500. So that's if you're below 50. Catch-up contributions did not change, but if you're over 50, you now can you have the ability to contribute a total of $27,000. So if you do that pre-tax, you're going to save tax on $27,000. If you have a Roth 401k, a Roth TSP, then you're going to now shelter $27,000 up to $27,000 tax-free forever. So your tax situation will determine where you should contribute, or I should say your income situation will determine that. In December, like I said, may be a good time to increase your workplace plan contributions to take advantage of the increase that starts in January 2022. If there's any questions about this along the way, please let me know and I'll be happy to answer those. Healthcare savings plans, so FSAs and HSAs. So FSA stands for flexible spending account and HSA stands for health savings account. There are some key differences here that you should be aware of. So FSAs are different than HSAs in that you do not get to roll over unlimited unused balances like you can with HSAs. So be sure to use any unspent funds before December 31st, 2021. Health FSAs have an additional option of allowing participants to roll over up to $550 of unused funds at the end of the year and still contribute to the maximum to their plan next year. But that is something that the workplace, your employer would have to decide. So the health FSA plans can elect either the carryover or the grace period. So you can actually have a grace period as well or a carryover. It's one or the other. And so whoever's doing your workplace plan will decide that. Here's some ideas. If you have some money left in this FSA account that you don't want to lose, because you will lose this money if you don't have a rollover option, and it's over $550. Maybe buying some new glasses. Some sort of delayed dental work might be good. Acupuncture actually qualifies for FSA. Gel shoe inserts actually qualify for FSAs. And I just found, I didn't know this one, you can stock up on sunscreen with SPF 15 or higher for the summertime when that comes. So all those things do qualify for FSA funds. And if you just do a Google or if you're on my email list, I will be sending out an email with a lot more information on how to use these funds. So I'll get that sent out shortly here once this video is all edited. Health savings accounts. So health savings accounts, you can only open and contribute if you have a qualifying high deductible health plan. For 2021, the maximum contribution amounts are $3,600 for individuals and $7,200 for a family coverage plan. If you're 55 or older though, you can add up to $1,000 more as a catch-up contribution. Okay, so let's talk about HSAs for a second. So HSAs are one of my favorite plans. Okay, I think HSAs are even more valuable than a Roth IRA, by the way, potentially. If you're contributing to an HSA, these accounts are what are called triple tax advantaged. Okay, so what that means is you can put in money, and when you put in money today, you get a tax deduction. So it's just like putting in your 401k or a traditional IRA. So you're going to get money off of your income and get the tax deduction. Many HSA plans also have the ability to invest your money, just like an IRA, once you achieve a certain balance. So usually it's $1,000, sometimes two. Once you get past that, you can invest the money in the HSA. And once that money is in the HSA, you're going to invest it and it's all going to grow tax deferred. You're not going to pay any tax on any of the gains in there. You don't pay capital gains tax like you would on a brokerage account. Money gets to grow tax deferred. And as long as you use the money in the future for healthcare expenses, and there's a big list, by the way, there's a lot of things you can use it for, then you could take money out of your HSA and use it for qualified healthcare expenses, 100% tax-free, including the gains from your investments. So it's a very, very valuable account. And a lot of people will put money in and just spend it in the same year. But I highly recommend, if you have the ability to not do that and to actually pay out of your cash flow and pay out of your pocket, to do so and then save those receipts. Okay, so set up a Google Drive folder, a Dropbox folder, or just a shoebox. Shoebox can be a little dangerous because these receipts, the carbon receipts can depreciate over time and they can lose the ability to see them. So at least take a picture, maybe keep it on your phone or something like that. But if you have an HSA and you don't take the money out today and you let the money invest in your HSA and you let it grow, you can take the money out anytime in the future and reimburse yourself for all medical expenses or any medical expenses 100% tax-free. So, for example, let's say you invested your money in your HSA and you invested aggressively and you made 10% per year. And we'll use what's called the rule of 72, right? So if you take 72 divided by your return, it will tell you how long it's going to take for your account to double. So if you get 10% per year average and you take 72 divided by 10, that's 7.2 years, your HSA will double in 7.2 years if your money's invested. So what could you do at that point? Well, if you can wait 7.2 years and just pay out of pocket along the way and let that money grow that you put in there tax deferred, you can take all that money out that you would have paid for healthcare expenses, reimburse yourself, and then you're still going to have the remaining balance inside of your HSA that's still in those growth assets that ideally will keep growing for you. So now you basically just all that money tax-free, you paid yourself back and you still have money in your HSA. And then once you're 65 or older, HSAs can be used just like an IRA where there's no more penalty for taking money out for things that are not healthcare. And you can use it just like an IRA and you can just take money out. You'll pay tax on it, okay? But if it's not for healthcare, but you might just want to keep that as your healthcare bucket because most everybody needs healthcare, and healthcare is not going down anytime soon until we get the robots, by the way. That'll be from our friend Elon Musk. But until the robots come to save us, healthcare has been going up at 5, 7, or 8% per year, depending on where you are, and that's a huge number. So, but again, if you don't need it, if you need the money out, you can take it out and pay tax. So that is something that's very, very, very important. Question here from somebody. Let's see. Jana asked this question. Let's bring this on here. So is HSA only through employer? No. Okay. So it's better if you can get an HSA through your employer because if you put it through your employer, you don't have to pay, I think it's your FICA taxes. Don't quote me on that. It's something, it's your FICA taxes, I believe it is. So the money goes in 100% pre-tax if it is through your employer. If you have a healthcare plan that is a high deductible health plan that qualifies for an HSA, but your employer doesn't offer that, you can go outside. And there are multiple providers, Fidelity, Lively, Optum, there's multiple providers that provide these plans, and you can go get your own. So you'll get the tax deferral, the tax deduction will come back to you on your tax return, but you don't get to skip those, and again, don't quote me on this, it's something, I think it is the FICA taxes, but it's like the disability and the other taxes you have to pay through your payroll. That you will have to pay that. So it's not as beneficial to get it outside of your employer, but you can still get it. So good question though, Jonna. Thank you. All right, moving on here. Okay, next thing. Did you meet your health insurance plan annual deductible? If you did, now it's time to max out. Go to the doctor, get checked out, get whatever test you need to get done, anything that will come out of pocket, and try to really max this out so that you take advantage of that for this year. I know it's only a couple weeks left, but hey, we'll do our best. Estate planning issues. So estate planning issues to think about. And this is a question for you. Have there been any changes to your family, heirs, or have you bought or sold any assets this year? If so, this is a good time to go ahead and schedule that appointment and consider reviewing your estate plan. If it goes into 2022, it's not down the world, but these are checklist items you want to do for yourself every year to just double check. Are there any gifts that still need to be made this year? So this is important. You have to make the gifts this year. So if you want to gift money to anybody, relatives, whatever it may be, you can give up to the annual exclusion amount of $15,000 for 2021. That's per year, per donee, so each person. And those gifts are tax-free. If you're married, each spouse can give up to $15,000 per person for a total of $30,000. Just a little point to remember, if you're going to give $30,000 from a couple to one individual, you want to either consider writing separate checks of $15,000 or just give from the $30,000 from a joint checking account. As long as you do one of those things, you'll be fine. For 2022, the annual exclusion amount is going to be going up by $1,000, so it'll be $16,000 per spouse. All right. Are you age 72 or older, or are you taking an RMD from an inherited IRA? If so, here's your reminder, okay? RMDs from multiple IRAs can be aggregated, okay? So let's say you have 5 IRAs. I see people like this all the time. They have 5 IRAs, and you got to take an RMD. You have to calculate what the RMD is from the account altogether, okay? So it's aggregation altogether. And you only have to take the total RMD for all the accounts. You can take that whole RMD from one IRA if you want to do that. You don't have to take a little bit from each one. But RMDs from inherited IRAs cannot be aggregated with traditional. So you have to do these separate, okay? So that's very important. Pay attention to this. RMDs, and RMDs, I should just clarify what that is. That's a required minimum distribution you have to take if you're 72 and older or if you have an inherited IRA. RMDs from employer retirement plans generally must be calculated and taken separately with no aggregation allowed. So if you have 3 or 4 401ks and you're 72 or older, you're going to have to do this separately, okay? However, 403b plans are an exception, and RMDs from multiple 403bs can be aggregated. Tricky stuff, I know, but I'm just trying to be helpful here for you. And most people, I haven't really actually seen somebody who has all this kind of stuff going on at 72 plus, but if you do, let's get things simplified for 2022. Get your accounts together, roll them to an IRA or something, or put it all in one 401k and simplify your life, okay? And here is another checklist of items to consider. Again, if you're on my email list, I will be sending this out, and I will be sending out links for some additional ideas on what to spend HSA or FSA money on. If you'd like to join our email list on my site, right now it still says the 2021 key financial numbers. I did just get the 2022 ready, so that will be going out shortly. So if you just sign up on that list, I'll send out the 2022 shortly, and you'll get the ongoing emails and announcements that we'll make through email. So a couple of things to consider. Once a year at a minimum is really good to check your credit reports for errors. Errors, there's something like errors on about 50% of credit reports, something like that. So you can get a free copy of your reports annually at annualcreditreport.com, or use a monitoring service like creditkarma.com. Both those are okay. You want to make sure you review your beneficiaries on all accounts. Many people I talk to just never selected a beneficiary, or they might have had an old spouse or an old, significant other. Make sure the stuff is updated, folks, because if you pass away and it goes to the wrong person, your heirs are going to go through heck and back, let's say hell and back, dealing with this, and the cost is going to be it's going to be a lot of problems. So you definitely want to make sure your beneficiaries are correct. Make sure you complete your open enrollment and you select all your benefits. I would highly recommend you update your budget/cash flow to review your spending, okay, to make sure that everything's on track. This is something that's important to do every single year. Even if you're somebody who keeps a good budget, then you still want to make sure things are, you can inspect what you expected, right? Inspect what you expected. Make sure that what you expected to have is there. If you're somebody that is not good at cash flow, budgeting, knowing what your expenses, and you're going to retirement, you're somebody perfect for our group program, okay? We're going to be doing accountability, systems. I'm going to help you set all this stuff up and how to automate all your savings. A lot of good stuff. But if you're somebody who's good at this, just do review and check it off. Ideally, let's pay off all your credit card debt. Get the credit cards out of your life. Get that done. And that is where I agree with Dave Ramsey. Credit cards are great if you're actually, I don't agree with him there. He says never use a credit card. I think credit cards are fine as long as you have good financial behaviors. If you're not good at paying off your balance every month, then stay away from credit cards. Next one is review your emergency fund. We want to make sure that that is a sufficient balance for you. This is another one, okay? When it comes to inflation, this is where things get a little choppy. I think most financial advisors will probably still tell you to keep somewhere between 3 to 6, maybe even 12 months of cash. It's tough because that money's depreciating pretty quickly. So I think that needs to be a little bit more individualized, to be honest. I think you need to have at least 3 months. That's kind of my minimum to keep that very, very safe. But beyond that, you may want to look at getting a little bit more return on some of that money. Again, it's up to you depending on your risk level, but something you want to make sure the balance is good. For those of you that like to overspend for Christmas, set your Christmas spending budget and stick to it, okay? It's so easy, especially with the cost of things. I mean, things have gone up. Inflation is real, right? No one's denying that at this point. The cost of things has gone up. So you're shopping, and just going to the grocery store, by the way, we're up about 15 to 20% because we buy mostly things that are like organic, really clean, natural foods. Those have gone up the most. Processed foods, we don't eat a lot of that. Those have stayed pretty reasonable, but the clean stuff has really gone up. Same thing for things like shopping. Honestly, I think Christmas should be about family, about being together and just being grateful for everything you have. So maybe this would be a good year to remember that. And but if you are going to have a Christmas spending budget, set it and stick to it. Next thing, start thinking of what goals that you have for 2022. So many people just go through life and they have no real direction. They don't have a written roadmap of what they want to achieve. And something that like just working with clients, especially ones that aren't necessarily like the financial experts, when we sit down and we map out, okay, well, what do you want to achieve? What are your goals? What are some of the things that you want to do? And we get those written out. And like writing your goals down is like, to me, it's like a spiritual exercise in a sense where you're now taking something and you're bringing it into existence, And so many people will just wallow through life and just kind of wade through and just like, oh, if it happens, it happens. If it doesn't, it doesn't. There's been many, many studies that show that if you write down your goals and you write down your targets, you are just multiple times more likely to achieve them. So I would highly recommend you sit down and just take some time just to think. And for 2022, at least write down 3 goals for yourself for what you want to do. And one thing could just be getting your stuff in order, you know what I mean? And setting goals. That could be one goal that you have is to set goals for yourself. I mean, it really could be that simple. Don't overthink it, but set some targets for yourself because I really think, this whole COVID thing has been an absolute nightmare. And it just seems like it's like this cycle where it's like, new variant, things, new vaccine shot or whatever, things open up a little bit and then boom, new variant again. And then we got to wait and things shut down and blah, 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 blah. Some of you guys are in states like Florida and Texas that have been relatively open. Tennessee, California, and where I'm at, Orange County has been pretty good because everyone here just kind of does their own thing. But LA is just like, it's weird. You go there, it just feels very different. So people that are living in places like that, it's been a very weird time these last couple years. So I want you to think about what goals you want to have for 2022 and what you're going to do to get yourself back on a good track, focused, and on what you want to do with your life and stop feeling just so stuck and like you're not making progress. So setting goals is super important. Next one, contract your insurance agent to make sure all your insurance policies still meet your needs. This is something good to do. You might want to actually ask if they give you a discount as well, by the way. There's a lot of times if you just ask, you'll get a discount. They'll put money in your pocket. And then their last thing I'm going to put here is to review your asset allocation and possibly rebalance your portfolio. You want to do that on a regular basis. Make sure things stay in line. Make sure your asset allocation doesn't get too out of whack. So it's a good time to do that this end of this year, especially if you have some downtime. So that's what I put down here for today for us to discuss. So if I miss anything, please let me know in the comments, and maybe I'll add that on the list here that I'll send out by email. But other than that, I want to wish everybody a Merry Christmas and a Happy New Year. I want to remind you to turn on your notifications for this group because Facebook has made some changes and I got some people saying they weren't getting notifications. So make sure you go in there. It's under your settings. You can turn on notifications. And if you'd like to consider joining our group program, go ahead and fill out the application. The application's free. There's no cost to it. The program I am going to charge for, but like I said, it will be discounted. And I think it's going to be something very special. And I'm going to put everything I have into it. I'm personally going to be doing all the one-on-one coaching when we do those one-on-one coaching sessions, but we'll also be learning in a group together. So I think it's going to be very, very good. And I would highly recommend if you're interested to check it out, especially if you're like 2 years, 2 years or more away from retirement. I think it'll be a wonderful program for you. So let me check these questions here before I wrap up for today. couple things left in the queue. Okay, so is an RMD a percentage of your total holdings or a set amount? It is a percentage. So if you just Google IRS RMD table, you'll be able to figure that out there. You can contact your tax or financial advisor as well to help you. But some investment companies will actually calculate that for you, so it might actually be on your statement. You can check there as well. But it is a percentage, and that percentage goes up each year because I think the IRS's goal is to get you to get all of your money out of your IRAs, pre-tax accounts before you pass away because you deferred all these years. So most likely won't all get out, but it could be a close amount to it. So that's a good question there. And this question about I-bonds, we talked about this at the beginning. So I talked a lot about this at the beginning. So I would go back to the beginning of our workshop to discuss that, whoever asked that one. So that's it, folks. So I want to say thank you for watching. Thank you for joining us today. 2022, I missed doing these lives. They actually give me energy. I really like them. I've just been so busy. I lost my assistant, and so I've been doing everything myself this last quarter, and it has not been fun at all. Have some interviews set up, so hopefully by early 2022, I have a new person to help us with our admin and everything like that. If you guys need anything, okay, feel free to reach out. Okay, you can reach out to me if you need something and you have questions. If you want to get set up with a call, let me see if I have this available here. I don't know if I have it ready. If you want to get set up for a call to talk about your retirement for 2022, I'm not taking any more calls for 2021. I'm done at this point, but I'll just say it. It's keepitsimplefinancial.com/talk. Okay, I don't know if I have this up and ready here. I don't have it ready. But it's keepitsimplefinancial.com/talk, or you can just go to my website, keepitsimplefinancial.com, and get my, you can go to the calendar link there. I think it's on the bottom here. Let's see. Yep, keepitsimplefinancial.com. There's a contact link. If you want to get a call set up for 2022, I'm already busy. So if you want to get in to discuss your retirement and get some help, then definitely go there and get that set up. But other than that, I appreciate you so much. Thank you again for everybody who gave me a birthday wish. It really meant a lot to me. It really meant a lot to me. It's so important to me to have another workshop today, even though I think crazy things are going on. But I appreciate you, and we'll see you in 2022. Okay, have a great rest of your year. And if you need anything at all, reach out. Have a great day. Bye.